Hi, I'm Mike Ward. I want to talk to you about 5 things that finance does not like about accounting. You may be aware that there's always differences between accountants and finance people. And the difference really stems from the fact that accounting is backward looking and it's conservative, and finance is based on the future and is much more about economics. So let's dig in and have a look at some of these issues. The first issue is EVA beats net profit. So let's focus for a moment on the income statement. Here is an example. And this is a typical annual income statement, just with numbers made up here, showing you how accountants like to look at things. And you will see we've got some revenue and some variable costs and expenses and interest and tax and so on. And the key number here at the end of the year is to focus on profit. How much profit did we make? And people misunderstand this concept because there is one key cost which is not reflected in the income statement, and it really should be. So you see, when it comes to working out what debt costs, the accountants look into the balance sheet and they say, how much debt did we have? And they multiply that by the cost of debt. I've just called that KD, the interest rate in other words, and that gives them the interest paid. But what they forget is that there's also equity in the business, and they need to multiply that by the cost of equity, if you like, the return that shareholders deserve. What should they get? And if you factor that in and you subtract the cost of equity, you find that it changes the numbers completely. And instead of showing a nice healthy profit, we are now showing a minus number. And the question is, what should we call that? Because it's not profit anymore. Profit is kind of established as being what it is in accounting. So over the years, finance people have referred to this as economic value added, or in this case, subtracted from the business. What it means is, although you may have made a profit, it wasn't sufficient to actually service the shareholders' requirements in terms of what they would have liked as a return. And a company which produced negative EVA would see its share price going down. Market cap, if you like, would be reduced because of that. So this is such an obvious thing, and one wonders why accounting stops at net profit. When I ask accountants about this, they always tell me, well, what is the cost of equity? And what I've learned is that the cost of equity, okay, it's something we grapple a bit with. We would expect it to be higher than the interest rate, simply because shareholders are not guaranteed a return at all. They may not get dividends, and certainly anything that there may not be enough profit to service shareholders, and they can't pull the plug on you like debt holders can. If you don't pay them their interest, then you're insolvent. So because of those risk factors, shareholders ought to really get a higher return than the cost of debt. But just because it's hard to estimate doesn't really mean that we shouldn't try. And so there's a whole stream of finance focused on what we call EVA, calculating EVA, and also its cousin, which is referred to as MVA, market value added, which is what you get if you take all the future EVAs and you discount them back to the present at the weighted average cost of capital. You can go and read up more about these issues. Let's move on to the second issue that there is between accounting and finance. Now, you will know that whenever a company spends money, it has to decide where it should go. Does it go onto the balance sheet, and we call that capitalization, or does it expense it through the income statement? And you will know that things like wages, salaries are expensed. But other things, for example, if you're buying a machine, that goes on the balance sheet and is depreciated, because the asset, if it's something like a machine, is going to last more than 1 year. And the income statement only reflects revenue and cost for a particular year. So, for example, as I'm showing you here, if you were to spend $100, say, on marketing, you'd find it under expenses. And that's a problem because it makes the assumption that the benefits of marketing all occurred in the same year. Now, sometimes that's true, but with a lot of businesses these days, that is not true. So if you'd spent $100 on a machine, it would have been added to the balance sheet, wouldn't it? And it would be an asset. And all you would see then at the end of the year is that machine would be depreciated, and you'd see coming through the income statement $10 of depreciation. And obviously that makes a very big difference if you're putting through only $10, say, versus $100 as a cost, as an expense. It's going to make a big difference. So the issue really is, does marketing really have any value? And I'm picking on marketing here because there are many costs which are like this, but marketing in particular, or customer retention might be a better name for this. Does that have a lasting benefit of more than a year? Now, this is an article I saw recently in the Financial Times talking about an investor. This guy's kind of a very famous guy, Gareth Sleep, and he ran a number of funds. Then he kind of disappeared into anonymity. But he wrote this in 2004. He wrote, "We often ask companies what they would do with windfall profits, and most would spend it on something or other or return the cash to shareholders. Almost no one replies, give it back to customers." Following on from this powerful insight was his argument that modern accounting standards, shaped in an age dominated by capital-intensive businesses such as railroads and steel mills, are poor at capturing the long-term value created by this sort of approach. So what he's arguing is that accounting has got very deep historical roots and is very focused on kind of traditional assets. And he made a lot of money for his investors, Mr. Sleep did, by recognizing that if you're a company like Amazon, for example, where every bit of profit that you make immediately goes into giving the customers a better experience or growing the business or your opportunities directly in line with your business, let's be clear here, then that really is going to get you customers forever. And so looking after customers, retention of customers really needs to be seen more as an asset. And so it's an accounting issue, because if you treat it as an expense, you're going to find that your balance sheet is too low and your profits are equally low because you're writing off everything. So that's something we need to talk more about, especially with technology type companies, internet-based things. Those sorts of companies are particularly affected by this. Of course, it brings about issues because people like to think, well, an asset is something that you have control over and that you could sell. But let's be clear, you can certainly sell a customer this. It can be worth a fortune. Look at what Facebook paid for WhatsApp. I mean, it's not that this isn't always an asset. Number 3, leases. Now, coming back to our machine, let's say we spend $100 on a machine. Now, if we buy that machine, it goes onto the balance sheet, is a new asset, and let's say we fund it with debt. Everyone understands that. And then, of course, we will depreciate that machine as we saw last time. That's what happens when you buy it. But many times companies choose to lease assets rather than to buy them. In which case, what happens is they pay a lease, let's say $10 for the year on that machine, and that's what you see in the income statement, but actually there's still debt on the balance sheet. The balance sheet doesn't balance anymore, but they signed an agreement which commits them to paying for that lease for a period of time. That's debt. So we refer to that as off-balance sheet financing, because you've really got the use of the asset and you have financed it and entered into a contract which incurs a commitment for you to pay cash flows to somebody every year. and it really should be shown up as debt, but it isn't unless you look in the footnotes. So this has been a problem for many years. Fortunately, the accounting profession more recently has started to deal with this, and this can, let's be clear, this can be a very big issue for some companies. If you take a look at FedEx, for example, and you look at their balance sheet and their income statement, you will see they lease billions of dollars of airplanes. They don't own them, but they're the ones who use them every single day, all the time. And but you won't find those assets on the balance sheet, and you won't find the debt on the balance sheet. It is just crazy. So new accounting standards, the International Financial Finance IFRS, have come up with IFRS 13, which requires this issue to be dealt with now, and these assets must be written back onto the balance sheet, and the debt shown as for what it is. So that takes us to issue number 4. What exactly is capital on the balance sheet? Well, here's a picture of the accounting balance sheet, and you can see that the assets, fixed and current assets, are funded. There's no money actually on the left-hand side as I've shown it over here. Of course, these pictures I'm showing you here often these days are one on top of the other and so on. But the balance sheet balances because the funding, which I'm calling capital here, must come from equity and debt, and it finances, that's what was used to finance all of the assets. Now, if you look in a bit more detail at the balance sheet, you're going to see a breakdown of these assets. We've got, on the asset side, we've got PPE, plant and equipment, property and equipment type of thing, investments we may have in other companies, maybe some intangible investments, machines, all of those sorts of things are in the fixed or non-current assets, as the accountants like to refer to them. And then we've got our working capital, inventory, accounts receivable, and cash. You need these things to run a business. Now, on the other side, financing all of this, the company issued ordinary shares, perhaps some preference shares, and over time there will be some retained earnings related to those ordinary shares, perhaps if they didn't pay out all the dividends and so on. And they have also borrowed money. Debt is sitting there. That's interest-bearing debt they've got from the bank. But also on the liability side of the balance sheet are things like accounts payable and deferred tax. Now, these are amounts that you owe in the first case to your suppliers, accounts payable, and deferred tax is money that you are keeping to pay the receiver of revenue. And so the balance sheet balances very neatly. The problem is there's a big difference with some of these means of financing. And so, but before we go there, let me just quickly show you how bad this can really be. So I found this balance sheet. This is Embraer. You may know of them. It's a Brazilian company. They make aircraft. And this is their total assets that you're seeing over here. You see some crazy things on here. You're going to see that, for example, they have got things called repository parts. I guess those are bits of aircraft. And they've got ST securities held to maturity, short-term securities. Those would be presumably shares and investments for sale. And these are not small numbers. Securities for trading. These are assets in their own balance sheet. And you can see if you look at the longer term assets, there are all kinds of guarantees and deferred taxes and derivatives and who knows what is going on here. So I'm just trying to keep things simple for you. Sometimes we have to spend quite a bit of time figuring out what is what on the balance sheet. If you go to the other side of the balance sheet, you also see, and the accountants call this shareholders' equity and liabilities. Now, strictly speaking, it's true, shareholders' equity is not a liability in an accounting sense, but it is a liability in the sense that that is where money came from to finance the assets. This is money which, in a sense, the company also owes to shareholders. They put it in, and whilst it's capital, it's equity capital, it's nevertheless, if they would like to get it back, let's put it that way. So if you look here, again, you're going to see all kinds of very interesting numbers over here, but you'll see in the middle there's a line there of non-interest bearing liabilities. And those are all kinds of things. Municipal taxes payable, and income taxes payable, provisions for environmental liabilities, contract advances. I mean, all kinds of strange things here. This is Embraer again. And at the very bottom, you'll see capital. That's the shareholders' equity at the end of the day here. But all of this is needed to fund the assets on the other side of the balance sheet. So let's simplify all of this again. I'm back to where we started with here. We've got our assets on the right-hand side, as I've got it here, and we've got our equity and liabilities, and the balance sheet must balance. Now, the problem we've got is that things like accounts payable and deferred tax do not incur a cost. They're not really a interest-bearing liability like debt or like shareholders. They don't require returns. You've got money from your suppliers, accounts payable is coming from your suppliers. They've given you credit. They want your business. And so we need to treat it in an economic sense. And so what we do is we subtract those kinds of things. Anything that's non-interest bearing or doesn't really cost us money is really free capital. And we like to subtract it from both sides of the balance sheet. And you'll see we've subtracted it. So on the one side, you've just got the debt now. And then we've got minus accounts payable and minus deferred tax on the asset side. And because we've subtracted something, we call it net assets as opposed to total assets, which is what the accountants would call it. And the net just means we've subtracted it. We use that word a lot in finance. Net assets, net cash flows, net present values means something has been subtracted. And we have subtracted those two items. And this is not a small thing. In some companies, these are not that material. Accounts payable is not such a big deal. But in certain types of businesses, particularly cash retailers, for example, it's huge. These numbers are very big, and it will make a very big difference to your analysis of the balance sheet. And also how you work out things like the weighted cost of capital, which we're coming to. So we refer to that portion of the balance sheet as not working capital, but net working capital for the same reason. So just to show you, here's Tesco, and you will see Tesco's total assets of 49 billion, I guess this is, pounds. But if you look at the long-term liabilities there, you're going to see accounts payable, do you see that? And other current liabilities, total current liabilities of 20 billion. That's not a small number. And that, we would argue, especially the accounts payable, we'd have to look at some of the other current liabilities in a bit more detail to see whether these are interest-bearing or not, but they ought to really be subtracted. It's, in a sense, a negative asset, and it's allowing you to fund your assets with free capital. So from an economic perspective, we would like to deduct it. So we do this because accounting is keeping assets, is just looking at assets versus liabilities. This is a liability of the company. That's true. The accountant is not wrong in that regard. But from an economic perspective, we need to distinguish between assets which actually are costing us something, the operating assets. The fifth item I want to talk about in terms of what accountants and finance people differ on relates to book values and market values. And in case you don't think that there's a big difference here, actually there is. If you were to take what the accountants refer to as being the book value of equity, what we saw just now, ordinary shares and retained earnings, all of those equity type things, and you compared it to the market capitalization of a company, in other words, what the stock market thinks or shareholders think, the number of shares times the share price gives us the market cap. And you were to plot these as a frequency plot here, and here I've taken the 600 biggest companies on the European market, the StockX 600, and I'm plotting the market to book equity ratio. Now, if accounting exactly agreed with shareholders, you'd expect that ratio to be 1. What the market says the equity is worth is what you see in the balance sheet. But it isn't. And you can see the median market to book ratio in Europe is about 2.6. That just means that the accountants are about 260% below what the investors actually believe the equity is worth. So that's a big problem. And you can see there, this varies quite a bit. You can get some, and it doesn't make much difference though which market you look like. You look at pretty much anywhere in the world, if you go and work out this ratio and you take the median value, you're going to find it's above 2, somewhere between 2 and 3 mostly. So we can't ignore this. So you see, the issue here is if we're using a discounted cash flow methodology, for example, we are going to look at the future cash flows, what we call the near term and the far term, into the long distant future, and we want to bring everything back to value the company, not in terms of its assets, but its cash flows that those assets will generate, and we call that the net present value. And to do that, we need to calculate the weighted average cost of capital. Now, if you have a look at my little picture on the left, you can see that, and here I'm working in euros, you can see I've got book value versus of equity versus the book value of debt here is about 1/3 debt and 2/3 equity. So if equity costs 6% and debt costs after tax 3%, then you can see when we put together our maths over here, you can see I'm getting a weighted average cost of 5%. And that's what many people use when they are doing discounted cash flows. But we would argue that in fact, actually that's wrong. We should use the market value of equity. And since that's going to be 2 or 3 times more than what the book value is, you can see it's going to increase the weighting of equity enormously. And you're going to find that you get WACCs which are much closer to the cost of equity. So, of course, which market cap do we want to use? Because here's Facebook, for example, and you can see we're looking at its share price over here, but its market cap is driven by its share price, and it can drop 30% in 6 months, and as it did in 2018. And you can see that we need to kind of be, we perhaps need to take a weighted average or an average of historical market cap over the last 2 or 3 years, something like that, to smooth this data a little bit. But nevertheless, we shouldn't ignore the fact that accounting tends to grossly underestimate the weighting of equity when it calculates things off book values. So why do we think it's important that we focus on market values and not book values? Well, book value is historical and often very old. Remember, accounting is based on cost. Historical cost is what's gone in. So if you bought land 100 years ago, as many companies probably did, it's often still sitting in the balance sheet at cost. But actually many of the assets in the business have increased, and it's just reflecting an old convention. So that can be an issue. The book value represents cost and not the value of those assets. So the problem is that if you're a shareholder and you go and buy 100 euros worth of a share, you want a return of 5%, let's say, not on what the books say you bought, the par value of the shares, but on what you paid, the 100 euros you invested in. You want to get your 6% return, or whatever you think the cost of equity ought to be. You want to get that on the full 100 euros that you invested. And so it's important that we take that into consideration. What about debt? Well, we must also use the market value of debt for all the same reasons, in fact. But mostly we don't have to worry too much about what the accountants say the value of debt is, because in the balance sheet, that's one of the few correct things. How much you owe the bank is normally correct, and the cash on the other side of the balance sheet is normally correct. The rest is, let's just say, driven by accounting conventions. So mostly the value of the debt in the balance sheet is correct, But sometimes if the debt has got fixed rate coupon and the yield changes, you could find that in fact the debt is over or undervalued in the balance sheet. But it's not often a problem. So please use market capitalization when one is looking at how much equity is really in there, especially when you are doing discounted cash flows. And with debt, one just needs to check. I hope you found this useful.